Here with more is Youssef Squali, Truist Securities Global Head of Internet and Media Research. Youssef, Meta, how much life does it have left in it?
Still a fair amount of life, Kelly, and thanks for having me on. So we think tonight is going to be interesting. I think overall it's going to be pretty muted, somewhat similar to what we saw out of Google. But I think when you parse out the numbers, what you'll see is the rate of decline has definitely improved. There is a chance we may even see them uptick a little bit on a reported basis. But even without that, this really has become more of a cost containment story. And we need to get to that $10 EPS a share for this year as quickly as we can. And I think management will have to speak to how they get there.
I mean, we all agree, and maybe it's oversimplistic, but that the stock has rallied on cost cuts, but they can't keep cutting all the way to the bone, right? So as that narrative runs out, is there more risk for the shares?
Well, I think, look, the stock is trading around 9 times cash flow, around 17 times PE. So even though the stock is up 70%, it is still not expensive. It's down 80%. It was down 80%, through last year before it started, resuming its increase. But clearly, we need to see top line reacceleration. I think some of that, it's within their control with things they're doing with TikTok. I think, with Reels. I think they've started gaining share back from TikTok, both in terms of engagement of users and even the number of people using the service. So that's really important. It would be great to see some dollar number associated with revenues from Reels. Last year was $3 billion. We think they're tracking to about $4.5 billion plus. So that will be really important. And clearly, the macro has a lot to do with all of these ad-driven names. And so at some point, hopefully later this year, we should start getting some improvement in the macro. And with it, Meta should be one of the best beneficiaries.
Yeah, the shares, by the way, even today are up 2% after Google's quarter. If you could just give me an additional word on that. I mean, what was it in particular that I think is going over so poorly with the market with Google today? Is it just the Microsoft comp? Is it what they said about ad or cloud? I mean, what to you is kind of the big, I don't want to call it disappointment, but something approaching that?
Well, I think the rhetoric around the name today has been around them losing a little bit of market share in search to Microsoft, right? Microsoft reported last night, I think they talked about 9 or 10% growth in search. Google grew 2%. So just looking at the numbers will tell you that clearly Microsoft is gaining a little bit. But we're talking about Microsoft owning single-digit percentage market relative to Google with 90% plus. So clearly it's a lot easier to move the needle on the lower share percentage. But I think that's temporary. I think Google is now leaning in very aggressively with AI. And I think over the next, few quarters, Google will start getting some of that share back. But I think that has been the primary driver of the shares not doing too well today.
That's a great point. They seem to be aggressive. I keep getting emails saying, here's how to use Bard and try it with this and try it with that. And Microsoft, too, by the way, goes to show how much is riding on this. Youssef, thanks for your time today. We appreciate it.